Let's talk about, move on to companies here. A little bit pressed for time, but we want to talk about Scott's Miracle Grow. And this is just a company that I saw and I liked, like, wow, everybody I think knows this company. So let's talk about the company a little bit here and give you the symbol. It's SMG. They're in the agricultural input industry. 7.6% shares are short on the float side, 73% institutional owned. PE ratio, not a good start here. It's 92.9 versus 29.9. Price to sales looks good, 0.9 versus 1.2. No price to book value, which is not good. That means you take away all the liabilities from the assets. There's no equity there, which we don't like seeing that. Price to cash flow, 5.5 versus 8.4. And the no PEG ratio, so not happy on that. No earnings growth over the last year. Sales were up 3.8%, which was a positive versus a decline of 5.9% for the industry. Analysts don't like this. They say the 5-year earnings per share growth estimate is a negative 164. I don't get why that number is that strange. Does pay a 4.9% dividend, no earnings, so you can't give you a payout ratio on that. We do see the dividends have not really grown much over the past few years. Balance sheet, current ratio 1.9 versus 1.7. That's good. No debt to equity because there is no equity, so you can't have a debt to equity ratio there. We do see that the net profit margin checks in at a minus 0.7, so they lose almost 1% every sale they make. Industry's a positive 3.8, and return on equity is only 5 versus 3.9. Chase, what do you got?
Yeah, so current price here for the Scott's Miracle Grow Company and their ticker symbol SMG, $53.99. It's fallen definitely from that 52-week high of $93.90. The low here is $45.61. Valuation looks pretty good on the business, though, going forward. You go out to September 2026, I see estimated earnings per share of $4.24. Actually gives a target sell price of $70.38, which is an estimated return of 30%. So it is actually right at our buy target there with that 30% margin of safety. But I got to say, I mean, no equity. I'd assume that debt is not pretty. I don't think you could justify buying a business like that, because sometimes we talk about franchise-based companies. We'll talk about McDonald's later on here. You kind of understand a little bit. They're asset light. I don't understand why Scott's Miracle Grow would have no equity.
I don't either. And I just want to make a couple points before we run out of time here. About 25% of the business is in stores like Lowe's and Home Depot. They're very well known there. They also have brands like Ortho and distribute Roundup to consumers. They're in Maryland, Marysville, Ohio. Founded in 1868, so definitely an old company. But 4 years ago, the stock was about $252 a share. They got hammered because they invested in a cannabis marijuana company.
Surprising.
And they thought it's going to do great. I think they paid about $2 billion for it, and it became virtually worthless. So they had to write all that off, made no money.
That's why they have no equity.
That's why they have no equity. It was gone. And this is why, remember how hot cannabis was?
Oh,
Everyone
yeah.
wanted to be part of it. And that has really faded. And I just, it's a shame that a company like Scott's Miracle Grow took that big risk on that.
You know, this is why you have to stay on top of your investments. I would never think it would make sense for a business like this to buy a cannabis company, but then all of a sudden you lost $2 billion worth of shareholders' value. I mean, I'm surprised the company doesn't get sued for that. That's a terrible investment decision.
Well, sometimes those lawsuits take years to develop, and I'm just looking now.
I was going to say, I mean, if they didn't do that, this might be a buy because you had $2 billion back to the balance sheet. I mean, could have created a positive equity there.
You know what the long-term debt is? 2.6 billion.
Wipe that away, you're probably fine. I mean, that is just ludicrous. They would have made that big of a mistake.
Crazy.